I'm Patek Philipp, probably the best ICT analyst you'll ever find. I show my students live analysis in NASDAQ and call my high probability draws for each day. Everything is to the point. We mainly work with timings such as 20-minute macros, key levels, and different anti-models, which help us neither to overtrade nor to chase. We have been doing this for over 1.5 years now, and our strike rate with the draws is extremely high. This is basically the easiest setup you can find in the AM session based on the first macro and based on a specific rule on that opening range gap. So you can see we have the 9:30 equity open. That is your AM session start. And you always have, every day, you have a opening range gap. So it's basically the settlement price from previous day to the opening price to the current day. And that is usually 4:15 p.m. to 9:30 a.m. And that opening range gap, if you have a specific amount of handles in that opening range gap, you can forecast or expect something to happen. For example, in this opening range gap, we have 20 to 75 handles. And this is usually where it trades to an old high when the opening range gap is up, or into an old low when it's down. And that can be previous day high, overnight high, for example, a London session high, a Asia high, or a pre-market session high that is between 6 a.m. and 9:30 a.m. And then usually it trades back to 50% of that opening range gap minimum, or even lower. So that is basically where we can find our entries inside this trade opportunity. So price goes, leaves this gap open, trades to a specific buy-side liquidity pool that is, for example, previous day high, and then it trades once more time into that high, makes the highs jagged, everything inside the 950 to 1010 macro. But now we have something that is very important. The macro, it's basically something that begins a move into specific liquidity and or imbalance. So in this case, we had an expansion up to this macro. This macro now already took the buy-side liquidity and goes into a consolidation here, or just smaller ranges. And right after that macro, we want to see another expansion. So the macro either has consolidation or expansion. If you see consolidation, you can expect expansion right after or inside the next macro. And if you have expansion inside the macro, you can usually find the consolidation right after. So in this case, it trades higher, has the consolidation here, makes a nice entry model here, and we have 3 different entry models for this. Trades there and then breaks lower. And we have, for example, at the beginning of 9:30 of that AM session, we can have a first presentation, for example. And that first presentation, this one, I'm gonna make this white. This first presentation can be our low-hanging fruit. So we can find a setup from here to that first presentation as our low-hanging fruit first setup. And once we trade below that first presentation, we can use that as inversion to trade lower into that open range gap midpoint. And if we have inside this area, if you look, for example, this would be on the regular trading hours, but if you look this kind of price action in here, in the electronic trading hours, you might have sell-side liquidity at that open range gap midpoint. So for example, there's sell-side liquidity resting. Then this is even better to find a setup from here to here. And we also have some other rules about the open range gap, but this is not what I want to cover in this video. I just want to cover this one. It's basically the easiest setup you can have. It's not every day, but if you find your open range gap between 20 to 75 handles, it can be 75.5 handles as well. It still counts to that 75 handle rule. So we can see that open range gap rule in here with that specific setup. If you find a consolidation before the macro then expands into the buy-side liquidity, for example. So we have expansion inside the macro. Then we have another consolidation, for example, right after the macro. So for example, it trades as a consolidation, goes into expansion inside the macro, right? Makes a higher high here, goes into a consolidation again, and uses the next macro to find the reversal. For example, let's say this one would be our macro here. And then we have the next macro from 1010. to, sorry, 1050 to 1110. So this would be then your timing or time window where you can find the setup back to the first presentation and or into that open image gap midpoint. Okay, so we have three different entry models for this case. The first one is a inversion Fabelli gap. So that means we have no market structure break to the downside. We only have this one busy or a bullish Fabelli gap that is a one single candle to the upside. So we have that higher high in here in that macro, and you can use the busy, the bullish Fabelli gap. Once we trade below that, we can use that as inversion. So it trades below and uses it then as a resistance to trade lower. We also have the typical market structure break to the downside and SIBI inside the premium range from this high to this low. So you have a market structure break, a SIBI or bearish fair value gap, and it's sitting at the 50% of that high and that low or above. And you can use this as an entry. We also have the typical breaker with fair value gap entry. So if you have a breaker coupled with that fair value gap, even though that fair value gap is not inside a premium from that high to this low, you can use this as an entry as well. Okay, so in this chart, we have that previous day's high. So this one is from the previous Thursday, and we are going to focus on this price action here on Wednesday. And I took that trade, and I'm going to show you the executions as well. So in here, we have that exact same setup and a bonus setup on the 15 seconds time frame here on that entry here. And I'm going to show you that as well. So we had a opening range gap higher, and this one was exactly 75.5 handles. And that is still inside that rule of 75 handles where we have that previous day's high or overnight high or a pre-market session high. So it leaves this open, trades into the high, and you can see where the expansion right before the macro. So the macro has smaller ranges in here. It slows down and then uses the time right after the macro for expansion. And we had this opening range gap being 75 handed, so we look for a trade into first presentation as a low hanging fruit, and then into, once we trade below that, into the opening range gap midpoint, and you can see there's a new week opening gap as well. So this new week opening gap is a key level, and I already made a video about that. We can also use as a draw on liquidity. So we have many things lining up here, and a sell-side liquidity pool inside the electronic trading hours. So in here you can see the sell-side liquidity down here. This is pre 9:30. So this 9:30 candle cannot be your first presentation. It has to be 9:31 or later. So because this one can't be your first presentation, we have this as your first presentation, and we always include the volume imbalances. So in here you can see we have a small volume imbalance here, one tick. So the closing price of that candle and the opening price of that candle is not the same, but here you can see the closing price is the same as the opening here. So we have this setup here where it trades higher into that macro, slows down, and then this second high here is higher than this one and takes out the buy side liquidity on the previous day's high. So we can use now this inversion fair value gap without any market structure breaks. So it did not trade below this low in here, but we can already use this inversion fair value gap as an entry here. Stop loss above this high, touches that old high again, trades lower, and then I re-entered here on that bearish breaker. So this one is also a re-entry that is only based on that breaker, not a fair value gap in here. That's also totally fine if you already have an entry up here. You can always add those premium arrays. For example, this fair value gap here, if this candle would have taken a retracement into that fair value gap here, it would be another re-entry. I then had a partial. I was partialing below that low in here. So every time it makes a new low, I'm taking a partial on that candle here, filled me up here, and then it did trade into the first presentation as a low hanging fruit. So this is basically your setup that is really good, and you don't need more than that. So it's always best to trade down into the open range gap midpoint or into the specific sell-side liquidity pool. but this one is already enough. You can see it 80 handles, and if you trade this like once or twice a week, then this is already enough for you. But then it trades below the first presentation, and I use a 15 seconds time frame to trade down into the sell-side liquidity down here. So in here you can see it did trade into the first presentation here as a retracement. We use it as resistance, trades lower, and I use this SIBI in here. It touched that SIBI and then traded a little bit lower, so it rejected from there, and I used that as an entry. I had a little bit of drawdown here, but you can see there's another fair value gap up here. So if you take all of this range in here, from this lower fair value gap to this upper fair value gap, you can see it trades in there and then goes lower. And the target down here, the sell-side liquidity and the sell-side minus sell-side liquidity below every low. So this one. And it trades there and goes finally into the opening range gap midpoint, this dotted line in here, and this new week opening gap CE, and then it goes into another consolidation.